All right, let's dive into something that's a real game changer for anyone in real estate, the 1031 exchange. If you've ever dreamed about growing your investment portfolio without getting slammed by taxes on every single sale, then you're in the right place. Let's get into it. Okay, so picture this. You bought an investment property a while back, you played your cards right, and now it's worth a lot more. You're ready to sell and cash in on that sweet, sweet profit. It's a great moment, right? But it comes with a catch. A big one. And there it is, the part nobody likes. See, the standard rule is pretty simple. You sell an investment for a gain, you owe taxes on that gain, right now. And that can take a massive chunk out of the money you are hoping to roll into your next big project. But what if I told you there's a special exception to that rule? Well, there is. It's hiding in plain sight in Section 1031 of the Internal Revenue Code, and it is designed specifically to help investors keep their money working for them instead of handing it over to the taxman. So here's the core idea, the whole shebang. A 1031 exchange lets you hit the pause button on paying capital gains tax. The catch? You have to take all those proceeds from the sale and reinvest them into a new, similar, or like-kind property. You're basically just swapping one investment for another. Now listen up, because this is the single biggest misconception out there. People love to call this tax-free. It is not tax-free. It is tax-deferred. Think of it this way. You aren't getting out of the tax. You're just pushing that bill further down the road to be dealt with later. It's a huge difference. Okay, so you're probably wondering, how does this actually work in the real world? Well, the most common type is called a deferred exchange. And you got to know, it runs on a very, very strict schedule. The entire thing hinges on two deadlines that are set in stone. The clock starts ticking the very day you sell your old property. From that day, you have exactly 45 days, not 46, to officially identify potential replacement properties. And from that same start date, you have a grand total of 180 days to actually close the deal and get the new property. Miss either of those dates and the whole exchange is off. Now, the hero of this whole process is someone called a qualified intermediary. This is a neutral third party that you are required to use. Here's why. They hold the money from your sale, so you never actually touch it. You sell your place, you pick out the new one, and then your intermediary uses your funds to buy it and transfers the title to you, all within those strict deadlines. Of course, you can't just swap any old thing for another. The properties have to be considered like kind. And you know what? That term means something a lot broader than you might think. First things first, both the property you're selling and the one you're buying have to be used for business or investment. That means your personal home or your family's vacation cabin? Nope, they don't count. Now, like kind is about the nature of the property, not how fancy it is. So check this out. A rental house is considered like kind to a vacant piece of land. Wild, right? The big rule to remember, though, is that U.S. property can only be swapped for other U.S. property. So, just to make it crystal clear, this whole strategy is centered on real estate that you hold as an investment or for your business. That's why your personal home is out. Same goes for stuff like inventory, a house that a developer builds just to flip immediately. And it definitely doesn't work for financial things like stocks and bonds. This is a tool for real property. Okay, now this strategy is incredibly powerful, for sure. But, and this is a big but, it is absolutely littered with traps. One wrong move, one simple mistake, and the whole thing can blow up, leaving you with a massive tax bill you weren't expecting. And hey, don't just take my word for it. The IRS itself puts out a pretty direct warning. They basically say you need to be really careful of anyone pushing these exchanges who isn't a qualified tax pro. They might make it sound too simple or promise you a tax-free deal, which, as we know, is not a thing. All right, if you remember only one trap, make it this one. This is the cardinal sin of the 1031 exchange. You cannot, under any circumstances, take control of the money. If you get your hands on the cash from the sale, even just for a second, the game is over. The exchange is disqualified, and that whole gain is now taxable. That's exactly why the qualified intermediary isn't just a good idea, it's the law. And that's not the only way to get into trouble. Missing those deadlines we talked about, that's an automatic fail. You also can't just use your own realtor or lawyer as your intermediary. They're not considered neutral. And you have got to do your homework on your intermediary, because if they go bankrupt while holding your cash, you could lose everything. So as we wrap this up, let's just lock in the one concept that matters more than anything else when it comes to the 1031 exchange. I'm going to say it one more time because it's that important. This is a deferral, not forgiveness. The tax liability doesn't vanish into thin air. It basically gets transferred from your old property to the new one. So when you eventually sell that new property down the line without another exchange, guess what? You'll owe tax on all the gains you've been rolling forward. You're just kicking the can down the road. But by letting you reinvest 100% of your money, a 1031 exchange can be an incredible engine for growing your wealth over time. The rules are tough, yes, but the potential is massive. So the real question you should be asking yourself, after talking to a tax professional, of course, is how can you put this powerful strategy to work for you?